Let's talk about upfront PMI. So there is a video about upfront MIP. And you're like, well, what's the difference? Very simple, guys. They're the same thing. The only difference is one, which we're about to talk about, is PMI, is private mortgage insurance. So meaning like conventional type loans, like the plain vanilla government, kind of what you hear on the radio type loans. And then the government-backed loans, FHA, VA, USDA, things like that. They don't have PMI, they have MIP, mortgage insurance premiums. Same thing, just different names, right? And even under those buckets, and we'll put a link in here to the government ones, the upfront MIP. We'll put links in there so you can see what that really means for each one of those particular programs. So if you're not doing a government program and you're thinking about doing upfront mortgage insurance or PMI, upfront private mortgage insurance, again, same thing. Here's what it is, and here's why you might want to do it, why you might not, things to consider. So upfront PMI is not mandatory for conventional financing. In fact, in this very market, we just don't see a lot of it these days. So what is it and when to do it? When should you do it? So first and foremost, mortgage insurance exists when for conventional financing, when 20% down, when somebody puts down less than 20% down. So why is that? Well, they're always thinking, they be in the lending community, right? Mortgage lenders. They're thinking that if they don't have 20% equity and somebody gets foreclosed on, there is a risk that they may not be able to sell the house and get all their money back. So until somebody reaches that 20% equity position, that's why mortgage insurance exists. And again, whether you hear it called MIP, PMI, PNI, not PNI, sorry, MI. So whether it's called MI, PMI, MIP, it's all the same thing, right? Fundamentally, it's just an insurance premium that the home buyer pays or the homeowner pays that protects the lender in the event there's a foreclosure, make sure the lender gets made whole. So with conventional financing, what we're talking about, meaning conventional means basically non-government loans. When there's not a 20% down payment, some form of mortgage insurance will exist. Now, some people say, we got a no PMI program. Yeah, it just got built into your rate. It still exists behind the scenes. That risk is still based in. It's okay. Those are good programs too. But today we're going to talk about the upfront. So what is the upfront? Upfront most of the time means that instead of somebody saying, hey, I don't want to pay X dollars a month for mortgage insurance, instead they might say, if I just paid you a lump sum at closing, let's get rid of that monthly piece. So the math, and again, this can vary over time, right? But I would say generically speaking, having done this for over 2 decades, what I've typically seen is that if it's putting down maybe 5 or 10% for a down payment, that break even a lot of times is around that 4-year period, meaning you're kind of prepaying about 4 years worth of that MIP or PMI or whatever you want to call it. You're of MI. So you're prepaying about 4 years worth. So is it good? I don't know. I don't love it. If somebody says, hey, I'm putting down 15%, right? And then all of a sudden now the break even might be 2 years because again, they're that much closer to 20%, so the cost gets less. So if you put down 5%, it's usually call it roughly 4 years. Put down 10%, maybe it's about a 3 to 4 time frame. Put down 15%, maybe it gets you in that 2-year range, give or take. So when should you do this? If let's pretend rates are stupid low, like during COVID, rates are at 3%, and somebody's buying a home and they're putting down 15%. At that time period, we're pretty certain that rates weren't coming back down to 3% anytime soon. It would make sense to get rid of the PMI if they want to within that 2 years. If they think they may be, I don't say overpaid, but they got aggressive with the purchase price, because then they don't have to worry about getting it canceled later on. So just remember this on conventional loans, unlike government loans, conventional, the monthly portion can go away. So again, when you prepay this all up front, that's well and good, but eventually you can always just remove it if you have enough equity in the home. So think about that too, is if instead of paying this, whatever that dollar amount is at closing, if you just use that for a bigger down payment, it gets you that much closer to that 20% equity when you can maybe cancel the MI. So we'll put a link somewhere down below for the canceling as well. But all it's a lot, and I get that this is a lot. So let's recap this. I don't typically advocate paying the MI upfront. The only time we do that is when somebody's really cash heavy and their debt ratios are really, really tight. So I need to get rid of that monthly piece to get them to qualify. But if they got extra cash and they could throw a couple grand towards it, that's certainly one reason to do it, just for qualifying. As far as buying out the PMI, again, I just don't love it because it can eventually go away. And especially with the recent 2 decades of housing appreciation we've seen, right? With the exception of just the mortgage crash back in 07, 08. But beyond that, even that recovered pretty quick. So I don't love upfront MIP or PMI. But again, there could be few situations where it does make sense if rates are really, really low. They think they're overpaying for a home, or they're at the top where maybe the appreciation is not going to be helping them out in the near future. I can justify that if it's a quick break even. So ultimately, the real answer is this: if you are exploring putting down upfront, paying the upfront mortgage insurance premium or PMI, private mortgage insurance, if you're exploring doing that, I'd say reach out and talk to us, and let's just walk through that with you and see what it means for the numbers. Again, it's a good program when you need it, but it's probably not something I'd recommend on a regular basis. So reach out to us, and as always, when you think mortgage, think Mark.